Testing. Okay. What's up, everybody? Back at it again. Make sure I share it. All right. We are live again. Everything looks good to go. Let's get right into it. So this is session number 6 of studying for the CPA exam. It's the FAR section using my own personal study tools that I've created called CPAcioli. The CPA Exam Prep you can actually afford. That's kind of like our call tag. 7-day free trial, no credit card required, and $19 a month after that, or you can pay yearly if you want it cheaper per month. But anyway, this is once again just a live stream of me going over the FAR section of the CPA exam and what you can kind of just see me working questions and pause the video if you need to go over them yourself, and then it'll show the explanation. And then we're going to do 30 now. We were doing 50, but it was taking a little too long, so we're going to do 30 at a time now, which should take about an hour. And so follow along if you want. And like I said, check out the website if you're interested in using the tool yourself. So let's get right into it. So here's the dashboard. You can see all your stats, and we're going to do practice, multiple choice. We're going to go unanswered, all difficulty, and all sub areas. As you can see here, all the sub areas. We'll just do all of them and just make sure and answered all the sub areas, and we'll begin. So yeah, follow along and let me know in the comments if you have any questions. So maintain just infrastructure assets. I would think it is expense the 450 and capitalize the 150. Nice. Because the 150 is an improvement, whereas the 450 is just a normal course of business. So that's why you'd only capitalize the improvement part. Yep. Then the FASB conceptual framework, equity or net assets for a non-profit entity is best described as. Assuming that, yeah, makes sense because net assets, kind of common sense, it's the assets that remain after deducting its liabilities. All right, let's see. Lease C enters into a 3-year operating lease with annual payments made at the end of each year of 10,000 a year rolling units. Okay, I believe you recognize the same lease expense over the period, so I think it would be 11,000 because it's the average of those three, which equals 11,000. Cool. Yeah. So for an operating lease, requires the leasee to recognize a single lease expense on a straight line basis over the lease term, computed as the total lease payments divided evenly over the term, regardless of the actual timing or amounts of individual cash payments. So the payments are different, but the actual lease expense per year is the same. Right, a company purchases a building with a roof, HVAC system, and structural shell that have significantly different useful lives. Componentized depreciation involves. I think B, yeah. Separately identifying and depreciating significant components over their own distinct useful lives, since they're separate components. Componentizing depreciation involves separately identifying significant components of an asset with materially different useful lives and depreciating each component separately over its own appropriate useful life rather than depreciating the entire asset as a single unit. Asset as a single depreciable unit. A not-for-profit entity's statement of functional expenses classifies its expenses into which broad categories? I believe it's A. Okay, cool. Program services and supporting services, such as management, general, and fundraising. Not-for-profit entities are required to present expenses by both natural classification and functional classification, dividing costs between program services and supporting services. Program services and supporting services are precisely the functional expense categories ASC requires not-for-profit entities to present. Cool. All right. Harborview Company factors $150K of accounts receivable to a financial institution without recourse, receiving cash proceeds of $138K. Assume a $12,000 loss on sale of receivables. Yeah, it's pretty easy. When receivables are factored without recourse and the transaction qualifies as a sale, the difference between the face amount of receivables factored and the cash proceeds received represent a loss on the sale of receivables. Yep, pretty easy there. Okay. Oh, goodness. Getting inventory is 3 years. Cost to retail ratio should be used. Beginning inventory at retail 30 versus 70 is 200. 205. Let's see net markups. Minus 150 is 45. Okay, because I feel like if you include markups, you need to include markdowns. So let's see. The conventional retail inventory method, the cost to retail ratio is computed by including net mark. Interesting. It's computed by including net markups, but excluding net markdowns from the retail value denominator, which builds in a conservative approximation of the cost or market. Interesting. Started that one actually. I always forget to star them, but that's a good little tool. So yeah, I'm gonna star that one and see. So you include net markups, but you don't include net markdowns because of, I guess, the conservatism principle. Interesting. That's required by the conventional retail methods ratio computation. This figure does not correctly include the markups that are retail base. It's required by the conventional retail methods ratio computation. Okay, good to know. And then see that arranges for another party to provide goods or services to a customer without itself controlling those goods or services before they're transferred to the customer is acting as an agent. Yep, pretty easy. Yeah, it's obviously an agent because it's not controlling those goods or services, and it should recognize revenue in the net amount of any fee or commission it retains. does not control those goods or services before transfer. An agent recognizes revenue only for its net fee or commission. I can control the good or service before transfer is the defining characteristic of an agent. And an agent recognizes revenue only in the net amount of its fee or commission. The accounting assumption that allows the economic life of a business to be divided into artificial time periods. Periodicity assumption. Just kind of memorize those, but it's pretty self-explanatory there. At year-end, a company has a temporary difference of $200K between the book and the tax basis of asset, caused by using straight-line depreciation for book purposes and accelerated depreciation for tax purposes. So, okay, let's think about this. The tax basis is lower than the book basis, meaning they're paying less right now, so they'll have to pay more later. I think you take the 21%, which is $42,000, and subtract it out from the $200,000 to get the liability that they owe. No, it just is the $42,000, I think. The deferred tax liability is measured by multiplying the taxable temporary difference by the enacted tax rate expected to apply in the period the difference reverses. Because accelerated tax depreciation has reduced the tax basis below book basis, taxable income will exceed book income in future periods as the difference reverses, creating a future tax obligation measured at the enacted rate. Okay, because that's how much taxes they'll owe in the future. Okay, that makes sense. It's just the tax amount. And so they'll owe $42,000 in taxes later, therefore that's the deferred tax liability, which is the taxable temporary difference times the tax rate. All right, the company reports operating expenses of $180 for the year. The amount of cash was paid for operating expenses during the year. Prepaid expenses increased. Okay, so indirect method starts with net income, and so you reverse it. But the direct method starts with operating expenses, so you add it like normal. Company reports operating expenses, excluding depreciation of increase. Cash paid for operating expenses equals reported operating expenses adjusted for the change in related prepaid assets and accrued liabilities. An increase in prepaid expenses An increase in prepaid expenses go up, and a decrease in the liabilities would also make it go up. Expenses. Both require additional cash outflow beyond the expense recognized. Because a decrease in liabilities means that cash expenses increase because you're paying off your liabilities. So that's why those are both positive. Okay. Another one on the star. Good question. I like it. I just need to lock in. But it makes sense now. A not-for-profit conducts a direct mail campaign that combines a fundraising appeal with educational program content. The campaign meets the criteria for joint cost allocation. Services and fundraising. Okay, I believe it's going to be $30,000. Cool. 60% of $50,000 is $30,000. Fundraising doesn't go in program service expense. Okay, 25% equity method with carrying amount of that. So carrying amount is greater than temporary. The decline in fair value of an equity method investment below its carrying amount is determined to be other than temporary. The investor recognizes an impairment loss equal to the excess of carrying amount over fair value, writing the investment down to the fair value. Pretty straightforward there. Company declares a 10% stock dividend on 50,000 shares of the $1 per common stock outstanding. Yeah. For a small stock dividend. I think a large stock dividend retained earnings doesn't change. I need to review that. Yeah. A small stock dividend, generally under 25% of shares outstanding, is capitalized at the fair value of the shares issued. Will retain earnings reduced by that fair value and the corresponding credit split between common stock and par and additional paid-in capital for the excess. Pretty straightforward. But I think a large stock dividend might not affect retained earnings. I'm not positive, but yeah. All right. The company has outstanding stock options that, if included in the diluted EPS, computation using the treasury stock method will result in diluted EPS being higher than basic. They're anti-dilutive, so they should be excluded. Yeah, if they're anti-dilutive, then they aren't included in the diluted EPS calculation. Yeah, because diluted EPS is meant to reflect the maximum potential dilution, not an increase in per share earnings. All right, halfway done, 80%. It's pretty good. Besides ownership percentage for the following is an indicator that an investor may have significant influence, even with less than 20%. Probably this. Yeah. Board representation, participation in policymaking processes, or material intercompany transactions with the investee. Significant influence can be indicated by factors beyond ownership percentage, including board representation, participation in policymaking, material intercompany transactions, interchange of managerial personnel, and technological dependency between investor and investee. Cool. In governmental fund accounting, an encumbrance represents I don't remember. Dang, expenditure. Not sure. Maybe. Dang. Okay. Encumbrance represents a commitment of budgetary resources for goods or services ordered but not yet received. Commitment of budgetary resources for goods or services ordered but not yet received. Yeah, just something you gotta memorize, really. Nothing else to it. An encumbrance represents a commitment of appropriated resources for goods or services ordered but not yet received. Reserve that portion of the budget until fulfillment or expenditure recognition. During a period of steadily rising prices, which inventory costing method generally result? Lowest reported cost of goods sold, the highest reported net income. Rising prices should be FIFO. Yeah, because first in, first out. So if prices are rising, then your older units are going to be cheaper. And first in, first out, meaning that that you pull the older units first. So that's why it would result in the lowest reported cost of goods sold and therefore the highest reported net income. There's a hard one. Okay. So it says, company enters into a non-cancelable purchase commitment to buy raw materials at a fixed price over the next 2 years. General recognition principles. How does this hold the executory contract? Maybe this. Nice. A wholly executory contract, one in which neither party has yet performed any of its obligations, is generally not recognized on the balance sheet because the mutually underperformed nature of the exchange means neither party has yet obtained an asset or incurred a present obligation to transfer economic benefits. Significant commitments are instead typically disclosed. Yeah, should be this. Favorable representation requires that information be complete, neutral, and free from material error, whereas relevance requires that information be capable of making a difference in users' decisions. Yeah, faithful representation and complete, neutral, free from material error, and relevance with its decision usefulness criterion, exactly as FASB concept statement number 8 specifies. Awesome. All right, 67% complete. 2 out of 3, 20 out of 30. Let's keep going. An acquirer pays $2 million cash to acquire 100% of the voting stock of a target in a business combination. At acquisition date, the target's identifiable assets have a fair value of $2.6 million and its liabilities have a fair value of $9 million. Well, let's think about this. Pays $2,000. That they pay $300,000 more, so it should be they should recognize $300,000 in goodwill. Nice. So they paid $2 million. The net identifiable assets acquired was $1.7 million, and so the difference is $300,000. And since they paid more than the net identifiable assets, then there's goodwill. If it were the other way around, it'd be a bargain purchase option. But since consideration transfer is greater than net identifiable assets acquired, then it's goodwill.
Hey, it's Matt Keen. Check out my new music video, Wide Eyed, on YouTube. Your one-stop shop for music.
All right. The company incurred $80,000 to replace the roof of a building it owns, exceeding the building's total useful life. So it's capitalized because it extends the building total useful life. So let's see. It's either A or D. Let's see. I'm gonna go A. Guess you derecognize the old asset. It's kind of interesting. When a replaced component was separately identified and its carrying amount is determinable, the old component is derecognized. Any remaining carrying amount recognized as a loss, and the cost of the new component is capitalized. Because the roof replacement extends the building's total useful life, and it's a betterment, it's capitalized. The $80,000 is capitalized, and then if I'm carrying amount, the replaced component is removed from the books. Since the old roof's $20,000 carrying amount was separately identified, it is derecognized, and the $80,000 new roof cost, which extends useful life, is capitalized as a betterment. Good to know. Cool. The company sells a building with a carrying amount of $600 to a buyer for $750. So This is going back for 10 years. How should the seller leasee account for the $750,000 cash received?
Hey, it's Matt Keen. Check out my new music video, Wide Out, on YouTube. Your one-stop shop for music. The transaction does not qualify as a sale under ASC 606. I think it's A. Okay. Recognize the $750,000 of financing lease liability and continue reporting the building as an asset since no sale occurred. When a sale-leaseback transaction fails to qualify as a sale due to the repurchase option not readily available in the marketplace, the seller leasee accounts for the cash received as a financing transaction rather than a sale, continuing to report the transferred assets on its book. And this is due to a repurchase option not readily available in the marketplace. Because the repurchase option prevents the transfer from qualifying as a sale, the $750K is recognized as a financing liability, and then the building remains on the seller leasee's books rather than being derecognized. The building remains on the seller leasee's books rather than being derecognized. Cool. 7 more. Let's go. Company adopts LIFO at the beginning of the current year when its inventory at the current year cost was $220 and the price index was 1 base year. Let's see. At the end of the current year. Current year cost the other present index is 1.1. Is the ending inventory balance. Okay. LIFO, current year cost was $220, the price index was 1.
It's cat time! We had so much fun teaming up with the Seraphim and Eilif for our new song, Iconic by Mistake. Check it out on YouTube, your one-stop shop for music.
Cost $250. $225.
Trying to think, I've had questions like this. I think you divide 250K by 1.1 to get 225K. And then you do something with it's either A or C. Okay, let's just see how to do it though. That's why I was doing that in my head and I got it wrong. Okay. Deflates any inventory current year call. Okay, so I was doing it right. So I did that divided by that. I thought it was 225. It's 227. Then minus the base layer is the new base layer. And you multiply that discrepancy by 1.1. And then you add it back to the base layer. Yeah, makes sense. All right, 6 more. On its statement of cash flows, in which section should a company classify the total cash proceeds received from selling a piece of equipment previously used in its operation? Should be investing. Cash proceeds from the sale of property, plant, and equipment are classified in full as an investing activity regardless of whether the sale results in a gain or loss. Full cash proceeds from selling equipment and investing type assets. Asset belongs entirely within investing activities regardless of any gain or loss recognized on the sale. According to the FASB conceptual framework, which qualitative characteristic of useful financial information requires that different, knowledgeable, and independent observers could reach a consensus that particular depiction is a for representation? Probably B or D. I think I would go B. Verifiability is the enhancing qualitative characteristic defines the ability of different knowledgeable and independent observers to reach consensus that a depiction is a faithful representation. A particular depiction is a faithful representation of the underlying phenomenon. Under the FASB conceptual framework, which fundamental qualitative characteristic requires a complete neutral free from error. We got that one a lot. And then relevance is predicted value, confirmatory value, and materiality. value, confirmatory value, materiality, faithful representation.
YouTube TV is amazing. Why would you settle for anything less?
Why would anybody
Completeness,
settle for just meh?
neutrality.
Can you imagine if
faithful
Zlatan was meh?
representation.
I call him. Lions cannot be cold.
There are precisely the three components.
Tiny
of
cups.
contained
Tiny
time,
cups.
components
I'll make the game
contained
beautiful.
signs of faithful representation.
Yeah, no.
Don't settle for meh. The #1 live TV service
All
now
right.
has 10 more affordable plans. Try
A
YouTube
company
TV
enters a
for free.
3-year contract to provide routine maintenance services on a customer's equipment. Total contract consideration is $180,000 paid in equal annual installments. Railroad should come recognize everyone. I think you just divide it by 3, so 60. Yeah. A series of distinct services that are substantially the same and have the same pattern of transfer to the customer are treated as a single performance obligation satisfied over time, with revenue recognized evenly over the service period, absent evidence of a different pattern. The company classifies a building as held for sale. At the date of classification, the building has a carrying amount of $900, a fair value of $950, an estimated cost to sell of $440. What amount should the company report for this building on its balance sheet at the date of classification? Held for sale, then maybe cost to sell should be included. So I'm gonna just guess here and go 910. So I'm gonna go B. Okay, so 900K, the lower of carrying amount or fair value less cost to sell. Depreciation ceases at classification. So the lower of carrying amount, which is 900, or fair value less cost to sell, which would be 910. So it's the lower of those would be 900, and the depreciation ceases at classification. Since the 900,000 carrying amount is lower than the 910 fair value less cost of sale, no write-down is needed, and depreciation ceases once the asset. Okay, and depreciation ceases once the asset is classified as held for sale. Yeah, okay. Depreciation ceases once the asset is classified as held for sale. Cool. So once the asset is classified as held for sale, depreciation ceases. All right, one more. City's debt service fund is responsible for making a $200,000
YouTube Premium is ad-free YouTube
and a
and
$60,000
background play.
interest
So
payment.
you can watch
due
videos
July
while
1st.
reading, searching, shopping. Try
The
1 month
current
free.
Fiscal year and how should the debt service fund report this $216K at the current fiscal year end? Both the city's formal debt service practice and available resources support recognizing the expenditure and fund liability as of the year end. Cool. Recognize a $260,000 expenditure and matured liability at year end under the early recognition provision. GASB provides a limited exception permitting governmental funds to recognize debt service expenditures and a maturity liability at year end when resources have been provided in advance to a debt service fund for a payment due early in the following fiscal year, consistent with the government's established debt service practice. Expenditure and matured liability recognized at year end. Because resources were provided in advance and the payment is due at the very start of the next fiscal year, consistent with the government's established debt service practice, GASB's exception permits recognizing the $260,000 as an expenditure and matured liability at year end. Cool, just something you got to memorize, I guess. To pay is a nothing but $5 to attend an annual fundraising. It includes a dinner with a fair value of $150K. Assume this. Okay, recognize 150K or 150 as exchange revenue, the nearest fair value, and the remaining 350 is contribution revenue. When a donor receives partial commensurate value in return for a payment, such as dinner, the payment is defurcated. The fair value of the benefit received is exchange transaction revenue, and the excess is contribution revenue. 150 of exchange revenue, fair value received, and 350 of contribution revenue. The excess paid. All right, I know we're past 30, but I want to end
based on your mood
W,
on the
so I want to
YouTube
get
Music
more
app.
right. Let's see. Not-for-profit receives a donated vehicle to be used in its delivery operations. Not-for-profit the contributed non-financial asset. Other donors' cost basis of the vehicle's current fair value. Donors' I'm gonna go A. Shoot. Gotta keep going. Crap. At its fair value on the date of donation with contribution revenue recognized for the same amount. revenue is either A or C. Contributed non-financial assets, such as donated vehicle, are recorded at their fair value on the date of donation with a corresponding amount recognized as contribution revenue. Fair value on the date of donation with contribution revenue recognized for the same amount. All right, we got to get one right. Let's go. Entity holds an available for sale debt security with an amortized cost of 100 and a fair value of 82. Management determines that 10,000 of the decline in fair value is attributable to expected credit losses. That 10,000 decline in fair value is attributable to expected credit losses. The remaining decline is attributable to non-credible factors such as change in market interest rates. How should the entity report this decline? Oh, okay. I think I remember that. Remember this. I think it's C. I think it's C. Okay, awesome. Let's go. So, recognize a $10,000 allowance for credit losses through net income, and the remaining $8,000 decline in other comprehensive income. So, the credit loss portion of a decline in fair value below amortized cost for an AFS debt security is recognized through an allowance for credit losses charged to net income, while the remaining non-credit related decline is recognized in other comprehensive income. Non-credit related portion. Non-credit related portion. So 8,000 other comprehensive income. So the ACL goes through net income, and the remaining $8,000 decline is in other comprehensive income. While the remaining 8,000 non-credit related decline is reported in other comprehensive income. Decline is reported in other comprehensive income consistent with these. I know this one though. Let's see.
Check out Goo Goo Gaga, the single from Catriel and Paco Amoroso and Jack Black on YouTube, your one-stop shop for music.
Without restrictions. Required to present exactly two classes of net assets on the face of the statement of financial position, with donor and without donor restrictions. All right, I'll wrap it up there. Well, let's see. Hold on. After Lakes for recess. I think it's a gain. It's not goodwill because it need to be the other way around. I think it's a gain. Nice. Yeah, it's a bargain purchase gain. When fair value of identifiable net assets exceeds consideration transfer, the result is a bargain purchase gain, recognized immediately as a gain in earnings after reassessment. Bargain purchase gain for 60. Because fair value of net assets exceeds consideration, the 60K excess is recorded as a gain in earnings on the acquisition date after confirming all measurements. All right, and that'll do it for this session. Yeah, this is a good session. Try to keep it around an hour. Let me know if y'all have any questions. That was session number 6 for FAR section using the CPA Exam Prep that I created myself. So I hope y'all enjoyed. Like I said, feel free to follow along. I'm going to start a Discord soon for people who are, watching and stuff. So stay tuned for that. Let me know if you have any more questions. And I hope to see y'all tomorrow. And I hope that y'all try out my app. So I highly recommend it. As you can see, it's got a pretty nice design. So I really think y'all will enjoy it. And it's free for 7 days and then cheap after that. So thanks for tuning in, and I will see y'all next time.